Global oil production. Hotspots. Crisis dossier. At the start of 2026, the global oil market looks calm in the numbers, but tense in the plumbing. Inventories have been building, and on paper, the world is not short of crude. Yet the system that turns underground reserves into usable energy is running with a growing list of single points of failure. Pipelines, export terminals, maritime choke points, insurance rules, and political decisions that can tighten supply faster than production can respond. January provided a clear demonstration of the new normal. Global supply fell by roughly 1.2 million barrels per day to around 106.6 million barrels per day, driven largely by severe winter conditions and operational disruptions. In a market that believes it is oversupplied, that kind of short-lived outage should be a footnote. Instead, it becomes a price signal, because traders and governments know that the next disruption may not be weather. It may be drones, sanctions enforcement, or a shipping corridor that suddenly becomes too risky to use. The central geopolitical keyhole remains the Persian Gulf. The Strait of Hormuz carries on the order of 20 million barrels per day of crude and refined products in normal times. That is why even a warning, a naval incident, or a change in insurance pricing can move markets before a single barrel is actually lost. By late February 2026, the most operationally sensitive hotspots are concentrated in a handful of regions: the Russia-Ukraine war zone and its export logistics, Kazakhstan's dependence on the CPC export route, Iran and the maritime routes connected to its regional network, Venezuela under renewed sanctions enforcement pressure, fragile producers such as Libya and Nigeria, where sabotage and theft function like a parallel industry, the Sudan-South Sudan export corridor, where one war can choke another country's revenues, and the Red Sea corridor, where attacks have already forced a large rerouting of shipping. For Europe, the consequence is not only the retail price of fuel. Energy price shocks transmit into inflation, interest rates, and exchange rates, and they shape domestic politics. Even if global inventories are high, the normal condition in 2026 is volatility. The system can look comfortable and still be one escalatory event away from stress. What counts as a problematic oil producer or corridor? In this dossier, a producer or transit corridor is considered problematic when the ability to deliver oil to market is structurally exposed to disruption. That disruption can come from warfare and proxy conflict, sanctions and their enforcement, infrastructure failure, labor disputes, extreme weather, theft and sabotage, legal and contractual disputes, or sudden market shocks that choke financing and operations. To keep the analysis usable, we classify current intensity into 3 levels. High intensity means frequent or meaningful disruptions, or an immediate bottleneck that could tighten the physical market. Medium intensity means recurring problems that create measurable volatility. Low intensity means the risk is latent, but the threat creates a premium that can widen quickly under stress. The global risk picture: calm quantities, fragile logistics. The backdrop to 2026 is a paradox. On the one hand, the world has been building inventories, and the headline narrative points to a comfortable supply cushion. In 2025, global stocks reportedly expanded by roughly 477 million barrels, equivalent to about 1.3 million barrels per day of average stock building. On the other hand, the market's confidence is repeatedly shaken by episodes that expose how quickly the delivery system can be interrupted. Institutional demand forecasts for 2026 also diverge, and the gap is large enough to change how the market prices risk. One major outlook emphasizes demand growth of roughly 0.85 million barrels per day. Another places it closer to about 1.2 million. A more optimistic view comes in around 1.4 million barrels per day. If demand growth lands near the lower end, disruptions tend to create spikes that fade. If it lands near the higher end, the very same disruption produces a larger and longer-lasting price impact. Unplanned outages are the bridge between geopolitics and price. In January 2026, aggregate unplanned disruptions were discussed in the neighborhood of 3 million barrels per day worldwide. Two examples illustrate the pattern. Cold weather in the United States was associated with a reduction on the order of 320,000 barrels per day, while Kazakhstan experienced combined production and export constraints of roughly 400,000 barrels per day or more in some windows. The lesson is not that any single outage is catastrophic. The lesson is that outages are increasingly correlated. Weather can combine with infrastructure stress, and geopolitical pressure can combine with tighter enforcement, insurance constraints, and longer shipping routes. Shipping disruptions add a second layer. The Red Sea and Bab el-Mandeb corridor demonstrated that oil risk is not only about production fields, it is about the routes that connect them to refineries and consumers. During 2024, flows through Bab el-Mandeb were widely described as falling from roughly 8.7 million barrels per day to about 4.0 million barrels per day in the January to August average. The world may still have the same barrels in aggregate, but it pays more to move them, waits longer to receive them, and carries higher insurance and security costs. In a multipolar environment, route security becomes a contested domain where regional actors, proxies, and great powers all try to shape costs and leverage. A short timeline of how we got here, 2022 to early 2026. From 2022 onward, several trends converged. The prolonged Russia-Ukraine war turned energy infrastructure into a strategic target and hardened sanctions into a long-term feature of the market. In 2023, the Strait of Hormuz continued to carry a flow comparable to roughly 1/5 of global oil consumption, keeping a structural risk premium in place. From November 2023, a wave of shipping attacks and threats in the Red Sea pushed parts of the market into detours and delays. By mid-2025, policy attention increasingly shifted to indirect routes and refined products linked to sanctioned crude, turning compliance and enforcement into a daily operational variable. In early 2026, fear of escalation involving Iran, combined with OPEC plus spare capacity politics, made the geopolitical premium persistent rather than episodic. Regional dossiers, where the system breaks: first Eurasia, war, logistics, and pipeline. Geopolitics. Eurasia is the clearest example of how modern conflict bleeds into commodity logistics. Attacks on pumping stations, storage sites, and rail or pipeline nodes are not only symbolic. They can reduce throughput, delay deliveries, and force rerouting. Even temporary reductions matter when the market is already watching for the next escalation. For Europe, the Eurasian problem is no longer only about crude volumes. It is also about refined products, shipping routes, and the political leverage embedded in the remaining pipeline connections. When a pipeline segment feeding Central Europe is disrupted, the economic impact is amplified by the regional concentration of alternatives and by the time it takes to replace flows through different refineries and ports. Kazakhstan. Export dependence and the CPC trap. Kazakhstan's vulnerability is not primarily in the oil fields themselves, it is in the exit door. A large share of export flows depend on the CPC route to the Black Sea. That creates a combined risk. Weather or technical issues can reduce terminal capacity at the same time as security threats or military spillover raise the risk profile of the route. When production and export constraints hit together, Kazakhstan can lose several 100,000 barrels per day in a short window. In a market that is sensitive to disruptions, that loss becomes a regional catalyst. It tightens supplies available to nearby refiners and increases competition for replacement barrels. The Middle East, export corridors, proxies, and the market airbag. In the Persian Gulf, the price of oil includes the price of deliverability. The Strait of Hormuz is the central switch. Because so much global flow passes through a narrow corridor, even partial disruption scenarios can create outsized market reactions. A notable feature of early 2026 is the role of Gulf producers as a stabilizing buffer. When escalation risk rises, some producers can raise exports or draw on logistical flexibility to dampen immediate shortages. This acts like an airbag. It does not remove the danger, but it can reduce the initial impact if a shock occurs. Still, the buffer is political as well as physical. Spare capacity and export decisions are embedded in alliance management, domestic revenue needs, and the strategic relationship with major consumers such as China, India, and Europe. Iraq, Kurdistan. When legal disputes become supply constraints, Iraq's northern export routes illustrate a different kind of bottleneck: legal and contractual disputes that keep barrels offline for years. When arbitration, payment terms, and authority disputes block a pipeline, the result is similar to conflict. Oil that exists cannot reach the market. In a volatile environment, these hidden constraints reduce flexibility and make the market more sensitive to other shocks. The Red Sea and Yemen. When the barrel is a root risk. The Red Sea crisis showed how quickly shipping can be reconfigured. Attacks and threats reduced flows through Bab el-Mandeb and pushed more traffic around the Cape of Good Hope. The world did not run out of oil, but it paid more to move it, waited longer to receive it, and carried higher insurance and security costs. Route risk matters because it interacts with refinery schedules and product markets. A longer route changes timing. Timing changes inventories. Inventories change price sensitivity. In a multipolar environment, route security is no longer guaranteed by a single hegemon. It becomes a contested domain where regional actors, proxies, and great powers all try to shape costs and leverage. Latin America. Sanctions enforcement and infrastructure corrosion. In Latin America, the pattern is a mix of politics and aging infrastructure. Venezuela is the clearest example of enforcement risk. Output and exports can swing rapidly when enforcement tightens, tankers are detained, or legal pressure increases on the networks that move sanctioned crude. In this environment, a disruption is not always a production accident. It can be a legal decision that removes shipping capacity overnight. Ecuador illustrates the power of natural disruption. Landslides and erosion can break pipelines, trigger force majeure, and reduce production materially for weeks. In one recent episode discussed in Market Reporting, the associated production impact was on the order of 133,000 barrels per day. Colombia adds another layer. Armed groups and sabotage can interrupt pipeline flows repeatedly. And in Brazil, labor disputes can reach even high-producing offshore fields, reminding the market that non-geopolitical disruptions still matter when the system is tight on flexibility. Finally, Guyana highlights a forward-looking risk: territorial disputes and legal uncertainty that do not immediately cut today's supply, but can delay the growth of tomorrow's supply. In a world that depends on incremental new barrels to balance demand, investment uncertainty becomes a strategic variable. Africa, fragile states, and the theft economy. Several African producers face a structural problem. The state does not fully control the territory that hosts the infrastructure. In such conditions, theft and sabotage are not occasional incidents. They can resemble an industry. They drain volumes, raise operating costs, and create unpredictable export schedules. Libya is a recurring case of institutional fragility. Even without dramatic airstrikes, budget deadlocks, competing authorities, and contractor arrears can translate into operational instability. Nigeria shows how pipeline tapping, sabotage, and security challenges can persist even when global prices are supportive. Sudan and South Sudan represent a different but equally severe vulnerability. One country's oil exports depend on a pipeline and port running through another country's war. In peacetime, the corridor from South Sudan toward Port Sudan has been associated with exports on the order of 100 to 150,000 barrels per day. When the transit corridor is threatened, the exporter faces an existential revenue shock. This is multipolar fragility in a literal sense. Sovereignty over reserves does not guarantee sovereignty over exports. How major analysts interpret the same reality. Across major institutions and analysts, a common theme emerges. Apparent abundance does not eliminate short-term scarcity. The differences lie in assumptions about demand growth and about how strongly OPEC Plus will manage supply. Some analyses emphasize that large inventories can cushion shocks, turning disruptions into temporary spikes. Others warn that correlated risks can overwhelm the cushion, especially if demand growth is stronger or if spare capacity becomes politically constrained. Sanctions analysis adds another dimension. Restrictions can reduce state revenue and constrain logistics, but gray networks can partially offset these effects. That shifts the battleground from the law on paper to enforcement in practice. Shipping services, insurance, financial channels, and port access. Strategic assessments of the Red Sea tend to be blunt. This is not a one-off episode. It is a new front where maritime pressure can be applied repeatedly and at scale. And analyses of Iran-related escalation consistently highlight second-order energy effects. Even limited military actions can have outsized consequences if they alter perceptions of risk around chokepoints. Iran as a system hub. 3 layers of risk. Iran influences global oil security through 3 overlapping layers. Layer 1 is sanctions and export capability. Even when Iranian barrels find ways to market, volumes can swing when pressure rises, when enforcement tightens, or when buyers become more cautious. In late 2025, loadings were widely described as falling by roughly 350,000 barrels per day from a prior peak, settling around 1.6 million barrels per day in some reporting windows. For the market, the specific number matters less than the signal. Exports are policy sensitive, and that sensitivity is part of the price. Layer 2 is regional influence through proxies and partner networks. The key point for energy markets is not ideology, it is operational reach. A proxy campaign that targets shipping, ports, or critical infrastructure can translate directly into higher costs and lower effective supply, even if production fields remain untouched. Layer 3 is Hormuz as the global switch. Hormuz is the most system-level vulnerability in the oil economy because it concentrates flows from multiple producers into a single corridor. In normal conditions, flows through Hormuz are on the order of 20 million barrels per day. A disruption here is not a regional problem. It is a global connectivity problem. Here is the causal chain, described in plain language. First, an escalation in a major conflict arena increases perceived risk. Second, that risk triggers warnings, attacks, or defensive actions that affect infrastructure and shipping. Third, reduced throughput, higher insurance costs, and delayed deliveries translate into lower effective supply. Fourth, markets respond with a risk premium, and governments respond with strategic stock decisions and diplomatic pressure. Finally, the response itself feeds back into the conflict by shaping revenues, domestic politics, and alliance behavior. The key insight is that sanctions pressure and security pressure can reinforce each other. When enforcement tightens on sanctioned trade, logistics become more dependent on opaque networks. those networks are more exposed to interdiction, seizures, and legal action. At the same time, security incidents in contested waters raise the cost of all shipping, including legitimate trade. The system becomes brittle because multiple pressures converge on the same logistical nodes. What this means for Europe, the euro, and everyday life. Europe is pursuing energy independence from Russian hydrocarbons, but it remains bound by physical constraints and global pricing. Legal measures and sanctions can reshape flows, yet they cannot eliminate Europe's exposure to global supply shocks that originate far beyond the continent. An important feature of the current phase is that restrictions increasingly target not only crude oil, but also refined products and the indirect routes by which sanctioned barrels are transformed and re-exported. This shifts pressure onto alternative supply chains and increases the importance of compliance, shipping documentation, and refinery routing. Europe also faces internal fault lines. Remaining pipeline dependencies can become political multipliers, especially in Central and Eastern Europe, where alternatives may be more limited or slower to scale. Disputes over transit, maintenance, or security can quickly become high-stakes domestic issues. For the euro area, energy shocks work through three channels. First is the inflation channel. Higher energy costs lift transportation and production inputs, spreading into broader prices. Second is the terms of trade channel. When an energy-importing economy pays more for imports, it experiences a transfer of purchasing power outward. Third is the exchange rate channel. Persistent energy stress can weigh on the currency through growth expectations and external balances. For the average citizen, the drama rarely arrives as a single explosion. It arrives as bills and uncertainty. Fuel prices move first, but the deeper impact shows up in food logistics, consumer goods pricing, and the cost of services that rely on energy-intensive supply chains. In policy terms, the menu is familiar but difficult. Strategic reserves can smooth shocks, but are not infinite. Diversifying routes and suppliers helps, but it takes time and investment. Enforcing sanctions may align with strategic goals, but it can also tighten markets in the short run. Physical protection of critical infrastructure becomes more important, not less, in an era of drones and hybrid tactics. The practical conclusion for 2026 is simple. Volatility is the baseline. High inventories reduce the likelihood of a sustained price explosion of the 2022 type, but the geopolitical premium remains embedded in the system. In a multipolar world, the oil market is not only an economic mechanism, it is a strategic arena where routes, rules, and risks are contested every day.